Welcome back to The Explainer. In our last session, we did some seriously heavy lifting. We tackled credit quality, troubled debt restructurings, and the nuts and bolts of calculating allowances. Well, today, we're transitioning from those big macro-level calculations down to the practical, day-to-day realities of accounts receivable. We're going to bridge the gap between high-level accounting theory and the actual daily journal entries that you and your team are out there posting.
We've got 4 main stops on our roadmap for this explainer. We'll start with the complete receivable lifecycle, look at some special case journal entries, build out the aging report, and wrap up by assessing the concentration of credit risk. All right, let's jump right into Section 1, the complete receivable lifecycle, where we track an invoice from its birth right through to resolution.
Understanding the exact chronological stages of a receivable is like having a cheat code. It literally eliminates the most common day-to-day accounting errors. If you know exactly where an invoice lives in its life cycle, you know exactly which accounting rule applies. Every single receivable goes through distinct stages, anchored by specific timing rules. It all kicks off with the sale, then moves to your period-end allowance updates, and then ideally ends with a normal, routine collection. But occasionally, things take a turn toward a write-off or maybe even a miraculous recovery down the road, and every single step has a strict protocol.
Let's zoom in on that inception moment. Imagine you ship a product on the 30th, but your billing team doesn't actually generate the invoice until the 2nd of the next month. Here's the crucial point. The trigger for your debit to accounts receivable and your credit to revenue happens the moment control transfers, when the goods are delivered or the services are performed. It does not happen simply when billing finally gets around to raising the invoice. Honestly, getting this timing wrong, it's one of the most frequent cutoff errors we see at period end. So, fast forward to collection. Let's contrast a normal, happy path payment with a bounced check, an NSF, or non-sufficient funds situation. Stage 3 is a breeze. Debit cash, credit AR. Boom, done. But if that check bounces, you've got to reverse the receipt to reinstate the AR and kickstart your collection efforts all over again. You debit AR to bring that customer's balance back to life and credit cash to get that phantom money off your ledger. You're basically hitting the rewind button. Okay, now imagine you've entirely given up on a customer. You've exhausted every collection effort, management authorized a stage 4 write-off, and you decreased your allowance. But then, out of nowhere, they actually pay. This is a stage 5 recovery. Now, if a previously written-off customer finally pays up, you absolutely must follow 2 strict steps to process it correctly. Step 1, reinstate the AR by debiting accounts receivable and crediting your allowance. Step 2, collect the cash by debiting cash and crediting AR. Whatever you do not take a shortcut straight to an expense or revenue account. You always have to run it through the allowance to keep your historical loss data perfectly accurate. Moving right along to Section 2, special case journal entries, focusing specifically on handling notes and non-accruals. When we step outside standard trade invoices, things like formal promissory notes require a slightly different touch. The initial debits and credits are straightforward. Issuing the note, simple. As time passes, you accrue interest, debiting interest receivable and crediting interest income. Easy enough, right? But pay really close attention here. If an account is placed on non-accrual status, you have to reverse that accrued interest. If collecting the principal or interest becomes doubtful, you absolutely cannot leave phantom income sitting on your P&L. You must reverse it. Debit interest income, credit interest receivable. It's just a classic fundamental application of conservative accounting.
Let's head into Section 3, the aging report. This is all about building and using the subledger. Now that we've mastered those micro-level entries for individual invoices and notes, it's time to zoom out and look at the entire portfolio. Enter the aging report. We desperately need this tool to aggregate all that daily data because the actual age of an invoice directly dictates the specific management action you need to take. It really is the beating heart of your AR subledger, transforming thousands of tiny individual journal entries into actionable big-picture intelligence.
Let's see how this intelligence is actually structured. Notice how the escalating severity of the aging bucket drives increasingly aggressive follow-ups and allowance reserving. Current invoices, just monitor them. But once you cross that 30-day line, reminder statements go out. Hit 31 to 60 days, and suddenly you're picking up the phone and considering credit holds. By 61 to 90 days, senior management is stepping in, and collections are officially escalated. And anything over 90 days puts you firmly in high credit risk territory. You apply the highest loss rate and start assessing for a write-off. The aging bucket doesn't just tell you how old the debt is, it is literally telling your team exactly what to do next.
And here is a golden rule for compliance. You must pull this data exactly on the balance sheet date. This ensures your allowance calculation reflects the true credit risk position at period end. You simply cannot run it 5 days early and just try to roll it forward with some rough estimates. The precision of your allowance relies entirely on the precision of this report's timing. No shortcuts. Finally, Section 4, Concentration of Credit Risk. Let's talk about spotting portfolio vulnerabilities. Reviewing your aging report is going to inevitably lead you to one final operational check, identifying who owes you the most money. This 10 to 20% range, that's your tripwire. If any single customer represents more than 10 to 20% of your total receivables, you've got a concentration risk that demands a serious individual assessment. Basically, you have way too many eggs in one basket, and your standard historical loss rates just aren't going to cut it anymore.
It can be a little startling when you look at it visually. Out of a hypothetical $500,000 ledger, well over half your pie could be dominated by just 2 customers. Customer A makes up 30%, and customer B makes up 28%. The remaining 42% is just scattered across everyone else. Think about it. If customer A catches a cold, your entire business might get pneumonia.
For those massive slices of the pie, you can't just apply a standard pooled aging rate anymore. You must evaluate their creditworthiness individually. You can't just wave your hand and say, well, customer A is current, so let's just apply a standard 1% reserve. Nope, you need to look at customer A's actual financial statements, their specific market conditions, and their capacity to pay off that massive balance. The rules absolutely change when the exposure becomes material. So as we wrap up this explainer, I want you to ask yourself a question. How closely are your daily journal entries communicating with your macro-level risk reporting? If a routine bounce check suddenly turns into a 90-day aging problem for your absolute biggest client, is your allowance accurately reflecting that real risk? Or are your micro entries totally disconnected from your macro management? Think about that bridge between the daily details and the big picture. Next time, in our final session together, we'll cover presentation and common mistakes. Thanks so much for learning with me today, and I'll see you in the next explainer.